management. Our first resource speaker for today is Ms. Toni Bautista. She's a chartered financial analyst. She has established her footing in the banking industry for more than 14 years, wherein she held various posts such as derivatives and structured products dealer, and in the financial market sales, covering corporations and financial institutions. Currently, she is a director still handling financial market sales in Standard Chartered Bank Philippines. Further to this, Toni has always been an advocate for continuing learning. She has been a residence resource speaker for Ateneo Center for Continuing Education, handling topics such as bank risk management, fundamentals of derivatives, and business of treasury, banking series. Toni graduated with a master's in applied mathematics, major in mathematical finance from the Ateneo de Manila University in 2008. As mentioned, she is a chartered financial analyst, a certified treasury professional, and an SEC certified fixed income and equity salesman. Let us all welcome our first speaker, Ms. Toni Bautista.
Thank you, Pams.
Hello. Hi, Toni. Welcome.
Hello. Thank you. And thank you again for inviting me, Mart, and the CFA Society Philippines on this inaugural and maiden intercollegiate bonds trading competition webinar series. So as it is, I'm co-teaching this session with my good friend Clive. I know that the participants already know Clive, mainly because I told him that essentially portfolio management is really his front. So I'll probably just start with yield curve and duration and then pass it on to our second speaker today, which is Clive. And the participants, as I've mentioned, would be very much familiar with Clive already. Allow me just to share my screen. Let me try this. Okay. Okay. So I understand that as it is, you've already covered in the webinar series basics of fixed income, GS valuation, auction process, how to use Bloomberg, and also code of ethics. But admittedly, I wanted to maybe revisit and review some of the concepts. No? So we know that in fixed income, essentially, it's just a borrowing and lending activity between two parties. So you have the issuer of a fixed income security. So this is the party with the obligation to repay interest and repay principal to the bondholder. So in any fixed income trade, there's always that two party. You would have the issuer and you would have the bondholder. The issuer is the party which is borrowing funds, and the bondholder is the party lending funds. So if you buy bonds, essentially what you are doing is that you are lending funds to the issuer of the security. You would have the maturity date. This is the date of the final principal payment. The tenor, this is time to maturity at any point in time. And we would normally have two markets. No, you would have the money market and the capital markets. No, if the maturity date of the fixed income security would be within or below 1 year, we would normally call this under the money market space. No, but if the maturity of the fixed income security would be beyond 1 year, you would now move on from the money market space to the capital market space. Now, another concept would be par or face value. And this is exactly the principle to be repaid at maturity. This is also our basis to compute for the coupon payments. We would normally have the bond price, which can either be at par, which is equal to 100, or a bond may trade at a premium, wherein the price is above 100, or the bond can trade at a discount wherein the price is below 100. Now, the coupon rate, this is the annual interest as a percentage of par. And essentially, this is the interest receivable of the bondholder, as long as the bond is outstanding and as long as the issuer is not yet in default. Now, aside from this, one more key thing to remember is the concept of yield. No? So the coupon rate, essentially, this is set at the primary issuance of any fixed income security. Now, as long as the bond is trading, no, you would have a yield which is constantly changing, because essentially that yield, no, is that unknown value which would make the price of the bond equal to either par, premium, or discount. So your yield, it is negatively or it's negatively correlated to the price. So the higher the yield, you would normally see lower bond prices, and therefore a drop in yields would result to higher prices. Aside from that, you would normally have also coupon frequency, which is the payments per year or the periodicity. This is also what we call it. No, you would have currency denomination, whether you're talking about a peso denominated bond, a euro denominated bond, a yen denominated bond. No, you would sometimes we would see what we call dual currency bonds, wherein interest payments in one currency and principal payments are in another currency. There is what you call your currency option bond, no? And then aside from that, in each of the issuance, there is normally some sort of documentation involved. And this is what you call your trust deed or indenture. This is the legal contract between the issuer and the bondholder. And this is normally held by what you call a trustee. So if, for example, you are a bondholder, so for the retail treasury bonds that essentially you can buy from your friendly banks, no, you won't have a copy of the indenture or the bond or the trustee. This is normally held, by a trustee, which is assigned by the issuer. And then finally, you would see several covenants, which is part of the trust deed and the offering circular or prospectus of any fixed income security. Now, you're also aware of the two types of markets in bonds. So you would have the primary market and the secondary market. The primary market is where we see an initial offering of the bond. So we normally have two types of primary offering. You would have a public or private placement. So for public offering, it means that the securities are normally registered with the securities regulator. And then aside from that, it's normally offered, here in the Philippines, it is normally offered to more than 19 lenders. So when you say that, so here in the Philippines, we have what we call our 19 lender rule. So when I say that we have that 19 lender rule, it means that if the number of bondholders are within 19 bondholders, this is considered a private placement. If the number of bondholders goes beyond 19 holders, then you are now looking at a public offering. So that's how you differentiate it here in the Philippines. Now, there's also that concept of shelf registration. What this means, when you say shelf, it means that it's a container technically, So what the issuer can do in order to make it more efficient when it comes to documentation is that they can register an entire issuance with regulators and then issue bonds over time in tranches. So once a shelf program, we call it a bond program, is approved, essentially whenever an issuer would need to tap that route for funding, they can just issue specific tranches following that bond program, following that shelf registration. Now, in the primary market, there are two types of offerings. So you can look at an underwritten offering or a best efforts offering. So when I say underwriting, it means that the issuer is in talks with several investment banks or bank syndicate, and that bank syndicate or investment bank would buy the entire issuance. And it's up to the investment bank or the bank syndicate to sell down the issuance to their own end clients. The best efforts offerings, in contrast, it means that the issuer would offer or will give the mandate to an investment bank, and that investment bank would sell down the bonds on a sales fee or commission basis. But from the name in itself, it's only best efforts in the way they sell down the securities. So that's a second type of primary market issuance. And then the third would be via auctions. And this is often used for government bonds. Here in the Philippines, we would have regular peso bond auctions. So we would have weekly treasury bills and weekly treasury bond auctions facilitated by the Bureau of Treasury. Now, the secondary market bond, this is where actual trading happens. So once a bond has been issued in the primary market, it can already be freely traded between the original bondholders to the new bondholders. So the original bondholders can effectively sell their holdings to new bondholders via the secondary market. So this is where we would see bid and offer pricing. The difference between the bid and the offer, that's what you call your bid-ask spread. this would reflect the issue's liquidity. So when I say that the issue's liquidity, it means that how easy would it be for you to unwind a position? The wider the bid and ask spread, that would normally be reflective of a more illiquid security. Now, in terms of trade settlement, it would depend on the market that you are looking at. For Philippine government bonds, the normal trade settlement is T+1. So T+1 means we will trade today, settlement will be the next valid business date. And then for dollar corporate bonds, dollar sovereign bonds, normally it is either T+2 or T+3, the secondary market. Now, in what follows, I have compiled several types of bonds. And I know that this would just be a review for you guys. You would normally have the first type and the most common type of debt or bond would be government debt. We have two types. You have sovereign bonds, which are issued by national governments. And it can be issued in the local or foreign currency. Here in the Philippines, we have peso-denominated bonds. We call them GS for short. And then we have dollar-denominated bonds, wherein the issuer is the Republic of the Philippines, and we call them ROPs for short. And then there are some non-sovereign government bonds, such as munis. So you have munis, wherein state, provinces, counties, and cities can issue bonds. Here in the Philippines, it's not as common at this point. Aside from that, we also have quasi-government bonds or agency bonds, which are issued by government-sponsored entities. So examples would be in the US, you have your Fannie Mae. There may be guaranteed, implicit guarantee in quasi-government bonds. So technically, if you were to analyze the credit of a quasi-bond, if there's explicit guarantee by the national government, then essentially you should look at the credit of the national government whenever you are analyzing that bonds. And then you would also have what we call supras or supranational bonds, which are issued by multilateral agencies, such as IMF, IFC, or World Bank. Now, another thing that it's a part of the fixed income market, we normally call it like an auxiliary product to the fixed income market because it facilitates efficiency in terms of settlement. We call it your repos or repurchase agreement. Normally, this is a source of short-term funding for bond dealers, and it's also a source of short-term requirement for the bonds, also for the bond dealers. So you can either be a repo seller or a repo buyer. If you are a repo seller, it means that you are selling the securities now with an agreement to repurchase back the securities, for example, 1 month from now. So what you are doing if you are the repo seller is that you are selling your bonds, thereby receiving cash. 1 month from now, you have that obligation to repurchase back the security. So it means that 1 month from now, you will receive back the security and pay your counterparty cash. So if you think about it, it is also the same. The cash flows would be the same as you entering into a collateralized borrowing activity. You borrow cash, and your collateral would be the bonds. So that is your position if you are the repo seller. Aside from this, you can also enter into a repo, or a reverse repo thereby, as the repo buyer. So when I say that you are the repo buyer, baliktad naman, so what you are doing is that you are buying the securities now. If you buy the securities now, it means that there's cash out today. 1 month from now, you would need to sell back the securities to your counterparty. And therefore, if you sell back the securities to your counterparty, you will receive back cash. So if you are the repo buyer, what you are doing is what you call collateralized lending of cash naman. So this is an auxiliary product for fixed income because it facilitates efficient and effective settlement. So it mitigates the possibility that counterparties would be short bonds or short cash because of having this product in place. Now, moving on to the main crux of our discussion. It's basically very easy, yield curves and duration. So, but yield curve, essentially, this just shows yields for bonds at different maturities. Now, take note that prior to you building a yield curve, for you to be able to build a yield curve, you need to pick the bonds. Now, the bonds in your yield curve should have the same currency, denomination, and tax treatment, credit risk, liquidity, coupon or reinvestment risk, periodicity, and yield calculation method. That is why if you look through textbooks, for example, you would often see that types of yield curves would be either a US government yield curve, to be specific, a Republic of the Philippines peso-denominated bond yield curve, for example, mainly because we need to make those qualifiers such that our graph and our representation in the curve, it would be apples to apples. So essentially, it just shows the direction of the yield and the relationship between the yield and the tenor of these bonds with the same currency denomination, credit risk, liquidity, and periodicity, and yield calculation method. Now, this is a sample yield curve. So I just got this from Bloomberg. You guys had a session on how to use Bloomberg. So I normally just type yield curve, and normally there would be drop down codes there. I don't memorize the codes anyway. So there would be a yield curve graph, and then I just shows Philippine peso government bonds. So as it is, as you can see here, it is upward sloping, from 3 months up to 10 years. But from 10 years up to 30 years, you can see a flat yield curve, right? So essentially, there are 3 main types of yield curves. So you can see a normal or upward sloping yield curve. That's why you call it's normal. The main reason here is usually, the longer the tenor of the bond, the greater the premium, the risk premium that investors would require, right? So that is why, as it is, if you're comparing a 10-year bond versus a 1-year bond, people would normally ask for a greater risk premium on the 10-year bond versus the 1-year bond. I normally think of it this way, You have to remember that if you are the bondholder, you are essentially at risk that the issuer will default prior to the maturity date of the bond. If you look at the time frame, 1 year versus a 10-year period, 1 year time, there is, of course, if you're looking at the financials, essentially, the financials in this case for a 1 year, it is, if you're looking at a very rosy financials from an issuer, a 1 year span, it would not be enough in order for you, for the financials of that issuer to turn around negatively. So as it is, your risk, your credit risk that the issuer will default prior to the maturity date of a 1 year security, it is less than the credit risk that your issuer will default within a 10-year time frame. So because of this, normally bond investors would require we call it a risk premium for a 10-year bond versus a 1-year bond. And that would be reflected in an upward sloping yield curve. And that's why we call it a normal yield curve. But there are also 2 other types of yield curves which may be apparent in actual market. We would normally see what you call a flat yield curve or a downward sloping yield curve. In this yield curve for the GS curve, you would see from 10 years to 30 years, you would see a flat yield curve. So parang the investors, they require the same level of yield, even if you extend the duration from 10 years up to 20 years and so forth. And the main reason here is normally, here in the GS curve market, the main reason here is you would normally have support in that tenor bucket in the form of the insurance companies. Because insurance companies, if you think about it, their liabilities would be long-term in nature. So in order for them to match that gap, they need the long-term assets. So that's why they're always looking for duration. And that would normally be reflected here in the flat yield curve. Now, a downward sloping yield curve, when do we normally see that? It means that investors, when you say that it's downward sloping, it means that a 1-year yield, it is higher than a 10-year yield, for example. this would normally be seen in situations wherein there is market distress, wherein we are anticipating a recession. Mainly because, so that is why investors are requiring a greater risk premium in the short term versus the long term. Because if we are able to surpass this recession, which is just a business cycle, essentially what happens there is that, of course, expectations would be the market would have improved, financials would have improved, the credit quality of the issuer would have improved. So that would normally be seen, as I mentioned, the downward sloping yield curve or the inverted yield curve that would be seen during times of recession. Now, this is also a sample US Treasury yield curve node. In this yield curve, I use US Treasuries. So US Treasuries are government securities which are dollar denominated, issued by the United States. So your credit risk here would be US credit risk, and this is the risk that the US will default. So if you look at the yield curve, it's more or less similar to the Philippine peso bond yield curve, wherein you would see upward sloping up until 5 years, but it turns flat. So as it is, most likely, if you think about most likely, as it is, it's still normal up until 5 years, mainly because so it is reflective that essentially we are not really anticipating any recession at this point, But if we see an inverted yield curve, that would normally cause some sort of concern on the part of the dealers, because that would normally be reflective of a recession. Okay, maybe I'll stop here first and check if I have any questions on the chat room. Okay. Okay. Let me move on because I'm using my office laptop because I'm in the office, and I'm not able to. I don't see the chats whenever I flash the presentation. So maybe if Ray and team and the MART secretary can help me, by messaging
we'll be
me
here if you have any questions in the chat.
Okay.
We'll be here.
You. Okay.
Thank you.
Let me move on. Okay, so in the next few slides, what I have here is really what we normally use as analysis of fixed income risk. And what we would normally use as an indicator of fixed income risk is is what you call the duration measure. Now there are two types of duration, actually three. You have the Macaulay duration, you have the modified duration, and you have the approximate effective duration. So back in the day when I was still studying, I would normally think of duration using two main concepts. So the first one is I would think of it as my payback period. What do I mean when I say payback period? So let's assume that you bought a bond today. So that means that you would have cash out. That would result to you needing to pay your counterparty cash today, such that the bonds will be lodged in your securities account. So my payback period is when I would be receiving back the investment that I paid for today. So essentially, that is Macaulay duration. That is my payback period. And how do you compute for it? So as Camille mentioned earlier, it's quite technical. But I would normally think of it as your Macaulay duration would just be your time-weighted present value of your cash flows in the bond. So let's assume here that you have a 3-year annual pay bond, and the coupon of the bond is currently at 4%. The YTM, which is what we use for present value, computing present value, and I know that you've already discussed this under bond valuation, is 5%. So let's assume that par or your principal is only 1,000 pesos. So we need to outline the cash flows. So you will be receiving 40 pesos, So this is 1,000, times 4%, and this is 40 pesos 1 year from now. another 40 pesos 2 years from now. And then at maturity, which is 3 years from now, you will be receiving 1,040. Now, next step is for us to compute for the present value of the cash flow. We will be computing the present value of the cash flow using our YTM. So the present value for 1 year would be 40 divided by 1.05, and this is equal to 38.10. The present value of the 40, which you will be receiving 2 years from now, would be 40 divided by 1.05 raised to 2, no? And this is equal to 36.28. And then finally, the cash flow that you will be receiving 3 years from now, you would need to divide by 1.05 raised to 3, and that is equal to 89.39. No? And then you will divide everything, and then you will get the sum. So essentially, we will get the summation of the present value of the cash flows. Now, we will compute for the weight. No? So you would have, so that's why I would normally think of it as a time-weighted sum of the present value of the cash flows. So the weight would be the present value of the cash flow divided by the total present value of the cash flows. Incidentally, the present value of the cash flow here, the total present value of the cash flow here is also your bond price, right? So from your bond valuation discussion. Now, so essentially, I will just do that 38.10 divided by 972.77 is 0.0392 and so forth. One check here is that your total weight should be equal to 1. Now, the last step is for you to multiply the weight with the tenor. So it is your time-weighted total present value of cash flows. That is your Macaulay duration. So your Macaulay duration would be 1 year multiplied by my weight for 1 year, 2 years multiplied by my weight for 2 years, and then finally 3 years multiplied by my weight for 3 years. So my Macaulay duration in my 3-year annual pay 4% bond with YTM 5% is 2.88. So it means that if I buy these bonds now, it means that I need to wait 2.88 years in order for me to get my money back. So that is your Macaulay duration, and that's how you interpret it. Now, another example. So let's assume that your periodicity is actually 2. So periodicity, it is defined as the number of coupon payments in a year. So in this illustration, I'm looking at a 3-year semi-annual pay 4% bond, and the YTM is still at 5%. So since it's a semi-annual pay bond and the coupon is 4%, you know that there are 6 coupon payments of 20. Assuming that we are also looking at a 1,000 par value. So essentially, we would do the same. We will lay down all of the cash flows of the bond, and then we will compute for the present value of the cash flows. And then we will again compute for the weight. And again, incidentally, 972.46 would be the price of this specific bond. Now, the final step here for us to compute for the Macaulay duration is to multiply each weight by the tenor. So the tenor here would be 0.5 years, 1 year, 1.5 years, 2 years, 2.5 years, and then finally 3 years. So this means that my Macaulay duration in a semi-annual pay bond is only at 2.85 years, which is less than my Macaulay duration if I am looking at an annual pay bond. Now, this is expected mainly because if you are looking at a semi-annual pay bond, it means that you would be receiving coupons more frequently. And that would result to a shorter payback period for you, right? So it really just makes sense if you think about it. Now, the second type of duration is what you call modified duration. And this is the approximate change for a 1% change in yield. So it is computed by dividing your Macaulay duration by 1 plus your yield to maturity. Now, before I move on to the two other types of duration, take note that, thank God for Excel, there is a formula in Excel called MDUR, and it automatically computes for your Macaulay duration. So you don't need to go through this building up of the cash flows via the table. But for me, it's also nice to know how Excel calculates these figures anyway, right? So that is your modified duration. So it is the approximate percentage change, no, in price for a 1% change in yield. So as it is, in Treasury, we would normally look at modified duration and approximate modified duration, no, in order for us to see the sensitivity of the bond, no, for yield changes. And we would normally use this in order for us to calculate our potential gain or loss in our bond holdings, depending on our prognosis on yield movements. Now, your approximate modified duration, no, it is computed, no, by you determining the price, no. If, for example, you will reduce the YTM by a certain amount minus the price, no, if you increase the YTM by a certain amount, divided by 2 times the initial price of the bond without the YTM changes, multiplied by that change in YTM. So that is your approximate modified duration. Now, let's consider this example. How do you compute for your approximate modified duration? So let's assume that if your YTM increases by 0.5%, full price, so when I say full price, this is your dirty price, no? It decreases to 960. Current price of the bond is at 980. No? If YTM moves lower by 0.5%, dirty price would increase to 1,002. How do you compute for your approximate modified duration? No? We will just employ our example earlier, no? Our expression earlier, I mean. So you would have 1,002 minus 960 divided by 2 times 980, which is your full price, no, multiplied by your change in yield, which in this case is 50 basis points rather, or 0.005. And you have 4.29. How do you interpret this number na 4.29? This means that if your YTM decreases by 1%, so without doing any calculations, you know that if your yield decreases, you should expect that bond prices will move lower. I will move higher rather, because of that inverse relationship between yield and prices. So if your YTM decreases by 1%, you should expect that the bond price will increase by approximately 4.29%. So that's why we use modified duration or approximate modified duration in order for us to ascertain the sensitivity of a certain bond, no, to yield changes, because we are able to calculate and estimate, no, by how much the bond price will move by just looking at our approximate modified duration. So what are the factors affecting duration? With other factors unchanged or ceteris paribus, no? So the longer the maturity, we would normally see a higher duration, so higher payback period, because you have a longer time to accumulate your payments, no? Except for some discount bonds. The higher the coupon rate, normally that would result to a lower duration, no? Because you're able to recover back your investment at a faster pace. And then finally, the higher the YTM, no, that would normally result to a lower duration. Now, if you're looking at a portfolio, how then do you use duration? No? Now, we have portfolio duration measures, no? Because essentially, you know, for each bond, you would have a certain duration. But if you're looking at an entire portfolio, how then do you employ the concept of duration in order for you to measure the risk in your portfolio? So there are 2 methods. No? The first one is to compute for the weighted average number of periods until portfolio cash flows are due to be received. So essentially, no, what you will be doing is that you will map out all of the cash flows in your bond holdings. Theoretically, this is correct, but empirically, it's very difficult to do. So what you will do here is that after you've laid down all of the cash flows, you can just compute for the Macaulay duration. But take note that this cannot be used if the bonds have embedded options. So if you're looking at a callable bond or a puttable bond, it would be difficult for you to use method 1. Now, the second method, and this is what would normally be done in actual practice, is that we will compute for the duration of each of our bond holdings, no? And then we will compute for the weighted average of the bonds durations depending on our bond holdings, depending on the volume, no? Or the market value of our holdings. Now, this may be used with effective durations, but essentially, no, what you are doing here is that if you are estimating the potential gain and loss in your portfolio using the weighted average of your bonds duration, what you are doing here is that you are assuming a parallel shift in the yield curve. So if, for example, you're holding on to a 2-year bond and a 10-year bond, no, you just compute for the weighted average of the duration of your bonds duration. No? If you're being asked, no, what would be the effect of BSP tightening, for example, in your portfolio, no? You would need to assume a parallel shift in the 2-year rate and the 10-year rate in order for you to come up with an estimate. And this would be one of the limitations in this measure. No? But empirically, this would normally be what is normally done, no, in order for you to account for your portfolio risk. Now, we also have a concept in Treasury. We call it PVO1 or PVBP, or price value of a basis point. So what this means, no, is what would be the change in the value of the bond for a 1 basis point change in YPM. No. So easiest way for you to compute for this, no, is you can compute for the price of the bond, no, if, for example, you deduct 1 basis point in the yield and you add 1 basis point in the yield. And the difference here would be the price value basis point, or the PVO1. So what it means is if yields move by 1 basis point, this would be your potential gain or loss. If yields move by 10 basis points, so this would be your potential gain or loss multiplied by 10. No, because essentially what you are measuring here would be your change in the market value of the bond, no, for just 1 basis point change in yields. So in this example, you have a 1 million peso 20-year, 6% annual pay bond, and the YTM is 5.88. So your starting point YTM is 5.88%. Now the value, let's assume that the bond value at YTM of 5.87, which is 1 basis point less than our yield today, no, it's equivalent to 1,015,069.54. Now, next step would be what would be the value of the bond, no, if the YTM is now 1 basis point higher. So you would have 1,012,730 divided by 0.36. So the difference here would be 2,399.17, but technically the difference in the yield, though, would be 2 basis points. So that is why your present value, or your PVO1 here, would be 2,339.18 divided by 2. That would be equivalent to 1,169.59. So what this means is that if your yield, no, moves higher by 5 basis points, for example, so essentially, if yields move higher by 5 basis points, you should expect that the bond price will move lower because of that inverse relationship. But the next question naman would be, how much would the bond price move? No? So our estimate here would be, we would need to multiply 5 basis points, or just 5, no, to our PVO1. So our PVO1 is 1169.59. I will multiply it by 5, no? And that would be equivalent to 5,847.95. Again, so this means that if yields move higher by 5 basis points, so it means that your yield would now be 5.93. No? You should expect that the bond value, no, will move lower by 5,847.95. So this is normally used, no, by our trader friends here because this would be their measure of risk. No? So my traders here, no, in SCB would normally talk in terms of PVO1 basis. So this is their measure of risk because this would allow them to estimate their potential gains or loss depending on how they think yields would move. Now, in Bloomberg, we have this YAS, or yield and spread analysis, you would see a lot of details here. No, you would see modified Macaulay duration here rather, which is 4.28, and I'm looking at this is RTB 5-15. So essentially, no, what this shows would be your DVO1. This is the same as your PVO1 also would be 429 on 1 million pesos, 1 million pesos. Now, the final part of my discussion would just really be an extension of analysis of risk before I pass it on to Clive. No, one key thing to remember, no, when you are looking at fixed income investing, no, whether because in the markup, I know that you are only constrained with government securities, but in reality, no, we have a lot of bonds available for investment. We would, whenever you are looking at investing, no, aside from looking at market factors, you should remember that for fixed income, it's essentially a borrowing and lending activity. If you would be investing in a fixed income security, no, it means that you will be lending funds to the issuer, and thereby this would involve credit analysis. No? So we would normally look at credit risk, spread risk, credit or downgrade risk, and market liquidity risk. So credit risk, this is the risk that the borrower or the issuer fails to pay interest or principal. Spread risk, this is the risk of the credit spread. So the credit spread, this is the add-on premium to the risk-free rate, no, that we impose on the yield. And this would normally be market dictated also, depending on depending on sentiment in the market. And aside from that, we can also look at firm-specific risks. No? Now, aside from that, we also look at credit downgrade risk, wherein the issuer's credit worthiness, it can decline, and thereby bond ratings would fall. We call it your downgrade. And this would normally be, this would affect this spreads on the issuer as well. And then finally, you would look at market liquidity risk, because your market liquidity risk, this is your ability not to sell or liquidate your position. So during times of market distress, normally we find it difficult to find a bid which is near our marks. So because of this, it may happen that if you sell a security, you would receive less than market value when you are selling your bond. Now, what are the components of credit risk? Just quickly, no, you would normally look at the default risk. What our measures here would be the probability of default. No? We would also look at loss severity. This is the amount or percentage of principal and interest lost if the borrower defaults. We have that concept of recovery rate. Normally for sovereign bonds, the recovery rate is 40%. What this means is that if the issuer is a sovereign, and if the issuer defaults, no, typically and historically, investors can recover 40% of the principal. So the expected loss essentially would be the probability of default, no, multiplied by the loss severity, and normally the loss severity is given by 1 minus your recovery rate. Now, for bonds, we also look at seniority ranking. No? So bonds may have different seniority. So when I say seniority, this would be our prioritization in terms of payment when the issuer defaults. So you have secured, meaning there is collateral involved, would normally have greater seniority than unsecured bonds. You would also have senior, junior, and subordinated notes. No? Senior note holders would have the greatest seniority. Now, all debt in the same category, we call them pari passu, same priority of claims. No? Now, in terms of credit ratings, we would have your three main credit rating agencies. You have Moody's, S&P, and Fitch. No? So your investment grade would normally be a BAA up until AAA. Anything below would be non-investment grade or speculative grade bonds. Now, aside from this, we would normally look at your yield spread, no, which is equal to your credit spread plus your liquidity premium. And the factors affecting yield spreads would be the bond quality. No, so spreads would be normally volatile for speculative grade bonds than for investment grade bonds. And we would normally look at the business cycle or the credit cycle. Spreads are narrowest when credit would be most available, and investors are optimistic when normally there are bad news, no, and everyone's pessimistic on the market. spreads would normally widen. Now, finally, since you are looking at government bonds in the markup, and if you are analyzing the credit of sovereign bonds, we would normally look at the ability and willingness to pay debt. So bondholders, we normally do not have any means of forcing an unwilling sovereign to pay its debt. And bonds may be denominated in local and foreign currency. So for foreign currency, there's that add-on risk because the issuer would need to buy foreign currency in order to pay the note holders. So we would normally look at the institutional effectiveness, commitment to repay debt, economic prospects, growth rate, per capita income, demographics, fiscal flexibility, the ability, willingness to increase taxes and decrease spending to service debt. And finally, you would normally look at actions of the central banks. So we would look at central bank credibility and the ability to pursue domestic objectives. Okay, I think this is my last slide. Let me, I'll pass on to Cams.
Okay, yes, thank you, Toni. So before we open the floor for any questions, we would move on to Clive's presentation. So as we all know, you have heard from Clive several times, but for a short introduction, Mr. Clive, our next lecturer, resident lecturer would be Mr. Clive Wisit, the Vice President and Head of Portfolio Management, a fixed income team of the Bank of the Philippine Islands. So, hello. Hi, Clive.
Hi. Hello, everyone. Good afternoon. So I'm going to present today portfolio management strategies. At this point in the markup, you've already been introduced to the basics of fixed income, GS valuation and trading, the auction process, and just earlier, some of the measures of interest rate risk in the form of duration, as well as a short introduction about yield curves. But today, I will be focusing on portfolio management strategy, something more practical. But we will move out of just simply looking at the government security space. We will take a look at other fixed income markets that portfolio managers normally take a look at as part of their fixed income portfolio management activities in banks. So let me just pick up my slides. Give me a second. Yeah. Okay. Yes. All right. Let me just Can you see the slides?
Yes, Clive. Pero
okay.
Siya naka-presentation. You can see the notes.
You can see the notes.
We can see the next slide.
Okay, let me swap this. Give me a sec. Ano ba to? Swap. Ano ba i-swap ito?
No, Clive, you should not. You cannot be in a presentation mode.
Okay, let me saglit
Do the edit mode. That's how it's in Zoom.
Sandali lang ha.
Okay, just a reminder for everyone while Clive is fixing the technical for his presentation. Please reserve your questions for Toni's presentation later. So Toni and Clive will be answering all of your questions after Clive's presentation. So, para sabay na sila.
Pa rin, ano? Wait
Actually,
lang, guys.
This is, I think this is okay. Yes,
okay
we
lang
can
ba?
see it. And can you try to proceed to the next one? Para lang makita natin.
Okay, give me a sec. Ayan.
Yes, that's good.
So, full screen na?
Yes, that's full screen na.
Okay, all right, got it. Okay, so sorry about that. So today I will be focusing on portfolio management strategies. Now, when you work for a bank, typically you will have a separate desk that handles the trading of certain markets. So there is a government securities trading desk that is focused on just trading government securities. You'll also have a foreign fixed income trading desk that's focused on trading foreign currency fixed income securities. But on the flip side, there will be also another desk that will be focusing on managing portfolios of fixed income securities. Now, managing a portfolio will sort of be different from trading in the sense that the intention for holding positions in fixed income securities would be different. Normally, portfolio management desks would have a medium to long-term perspective on having or opening positions in fixed income securities. So for today's lecture, the focus will be on managing portfolios of fixed income securities, not simply to earn a quick buck from churning or from quickly selling fixed income securities, but rather it's to have a medium to long-term perspective on investments. So today's lecture will cover two parts. You will have bond level strategies for portfolio management as well as portfolio level strategies. Okay, let's start off first with bond level strategies. So these are basically what we will be discussing today. Very simple, very practical. You can actually apply this on a personal level on your own respective retail portfolios of fixed income securities that you may have as a retail investor yourself. One tried and tested strategy when you are deciding to buy a bond is the rule of thumb, buy high, sell low. But again, the buy high, sell low strategy works only for interest rate markets. So whenever you're deciding to buy a security, make sure that you will keep in mind that you have to buy the security when the yield is high and sell the security when the yield is low. And this is because of the inverse relationship of yield and price for fixed income. Okay, and then the other three bond level strategies that we will discuss is relative value, curve trading or curve investing, as well as spread trading or spread investment. Now, what's great about Toni's lecture a while ago, she was able to delve a little bit in terms of curves, yield curves, as well as spreads. So which is a good introduction to our practical application today, which is spread trading as well as curve trading. All right, let me introduce you to the concept of relative value. Now, whenever you are in you are in investments, one of the reasons why you're hired is because you have a keen eye on looking for value. And that is a very important skill when you are in the financial markets. You should be able to find those particular sectors, those particular instruments where you can actually see value. Value is very important. And diba, that's exactly how you're able to generate returns. Your ability to generate alpha, quote unquote, is your ability to generate abnormal returns better than the rest of the market. And that's what you try to do whenever you are a fixed income trader, fixed income portfolio manager. And one way of looking at value is not just looking at the absolute yield that you can get from holding on to an investment. You can also generate alpha by doing relative value analysis. And this is one example by which a cross-asset portfolio manager can actually derive relative value by using strategies that focus on credit rating. So normally, when you're evaluating different fixed income securities, one way of looking at relative value is by comparing different securities with the same credit rating. So in this example, I've identified a number of securities by different issuers, but they all have the same credit rating. And you'll notice General Motors, General Mills, Jefferies Financial Group, and Fortune Brands Home and Security. These are examples of issuers of fixed income securities from different industries. However, what is common among all of these is that they all have the same credit risk. The market perceives their credit risk to all be the same. They're from the same line. They're all under the BBB credit rating space. Now that makes it easier for you to do the analysis. Now that you've selected 4 names for fixed income securities with the same credit rating, now's the time to look for relative value. Which particular bonds are likely to maximize your returns given that they all have the same risk, same BBB risk. So in this case, I've highlighted General Motors and Jefferies Financial Group simply because they are yielding the highest. They are yielding at 4.8% thereabouts, compared to General Mills and Fortune Brands, which are just yielding 4.2 and 4.1% respectively. Now, apart from the fact that they are all the same credit rating, it's important that in terms of tenor, they are also the same in terms of duration or tenor risk. So in this case, they are all within that 4.8 to 4.9 year tenor. So it makes them really comparable. And again, when you are in investments, you want to be able to make comparisons to find value. You can only find value when you are able to find a sample of securities wherein they are all similar with respect to a particular parameter. In this case, the parameter has been set that they are all triple B and they all are similar tenor. Right? So that's one way of looking at relative value. The reason why General Motors and Jefferies Financial Group have relative value is because they are all the highest yielding for the same type of risk. Okay, next is to compare different fixed income securities within the same industry. So in this case, I've identified 5 names or 5 particular issuers of debt that are all from the communications equipment industry. And they all happen to be in the United States. And you'll notice they all have different credit ratings, right? Now, the reason why we can do this analysis is because they are all from the same industry. Okay, so they're all competitors and they all come from the United States. Now, an important thing to note of here is when you do this kind of relative value analysis, you have to make sure that the tenor or the tenor is similar. So here, they're all within that bucket of 5 to 6 years tenor. So it makes the analysis a lot easier for you. So in this case, which particular bonds are you likely to buy? Okay. Now it's difficult. Here, let me give you. There's a disclaimer here. It's difficult to make relative value analysis whenever there are certain parameters that are not the same. Fine, they are all from the same industry and they all fall in that same sample of communications equipment issues. However, they all have different credit ratings. They have the same tenor, 5 years, but they're different in terms of credit ratings. So there isn't a direct comparison that you can make apart from the fact that they all come from the same industry and they have similar tenor. So in this case, what I did was to find what particular names in this sample have the similar credit rating, a similar credit rating. And I've identified Apple as well as Cisco having a similar credit rating. They are both under that AA credit rating space. Not necessarily the same because one is the AA plus and the other is AA minus. However, you can consider them comparable. Okay. Now, given that they are comparable in terms of credit rating, they're both from AA, meaning they're close to, you would feel some level of comfort that you will be repaid principal and interest because it is an A-rated paper, AA rated. In terms of these securities, you would choose Apple over Cisco, all right? Because it is yielding 3.58 rather than 3.49 for Cisco. So these are some of the more practical tips that we could give to you whenever you are looking for particular names with relative value. You look at it from a credit rating standpoint, and in this case, in this particular example, you look at it from a similar industry comparable standpoint. Another way for you to look at relative value is by taking a look at securities by the same issuer but across different tenors. At dito na pumapasok yung term structure of interest rates. Yung yield curve ang tawag natin dyan. So ang yield curve, this is actually the yield curve of Philippine government securities, but this is a dated slide. Admittedly, I think this slide was from 2018, late 2018. So you'll notice that the yields are quite high. So remember, in the yield curve, as mentioned by Toni a while ago, a yield curve, one of the requirements for you to construct a yield curve or to have a portfolio of securities wherein you are invested across the yield curve is that these securities must have the same risk and they must be from the same issuer. So you cannot establish a yield curve if they are from different credit ratings, different issuers, or different risk profiles. They should all be the same or have homogeneous risk. And for them to have homogeneous risk, it should have the same issuer. Okay, so in this case, the Philippine government is an issuer. So in this case, if you plot the yields of the government securities across the curve, this is what it will look like. So here, where is the relative value? The relative value is clearly on the 5-year and 7-year tenor. And why is this so? How do you know? Kasi medyo flat yung yield curve in this particular example. And I will show you a yield curve. And this is the yield curve of Philippine government securities back in 2018, late 2018. So the yield curve doesn't seem to be a perfect upward sloping, well and nice behaved yield curve, it actually has certain kinks. And where do you see the kinks? Can you see my question lang? Nakikita niyo ba yung arrow ko? Hindi. Ayan. Wait lang. Ay, shucks. Wait lang guys. Hindi ko maano yung arrow ko. Okay, anyway, it's difficult for me to move the arrow. So what I want to highlight here is the yield curve. This particular yield curve example shows to you that the yields on the 5-year, 7-year, 8-year, and 9-year, as well as the 10-year tenor, all seem to be very similar. And they are all at the 7% handle. Now, if you are looking at relative value means which is the highest yielding within this sample. So since they all have the same yield, they're all at the 7% handle, ang magkakatalo ka na lang dun sa risk. So relative value in the yield curve is which parts or which sectors of the yield curve have the highest yield for the lowest possible level of risk. And in this case, in the fixed income space, risk is measured by duration or tenor. So that's the reason why in this example, I've chosen the 5-year and the 7-year tenor as the securities with the highest relative value because they have the lowest level of risk for a similar yield profile. You'll notice lahat sila nasa around 7%, right? But because the 5-year tenor and the 7-year tenor are the lowest risk for the same yield, these have the relative value. I hope that's clear. That's how actual traders and portfolio managers that look at the Philippine government securities space, that's how they select GS with relative value. So ang kagandahan dyan, if there are certain sectors of the curve that are flat, you go to the shortest tenor. Doon ang may relative value. Okay. All right. So that is an example of selecting securities along the curve for relative value. Now, this is an offshoot of the discussions about yield curves a while ago. It's also possible to do curve trading. Now, what is curve trading? Curve trading means you buy and sell securities across different parts of the curve. You can buy certain securities on one part of the curve and sell securities in another part of the curve. But a basic premise here is that you have to have a view on the slope of the yield curve. So the yield curve can either be flat, it can be steep, or it can be flattening or steepening. So given what is your view, whether your view is you expect to see the yield curve to flatten in the near term or to steepen in the near term, you will make that decision to buy or sell securities in different parts of the curve. So let's talk about a steepener. So the upper left side of this table. So for a steepener, the pivot is actually the middle or the belly of the yield curve. So whenever you see a steepening yield curve, what's going to happen is the short dates or the shorter end of the yield curve is going to fall and the long end of the yield curve is going to rise. That's what a steepener is. So given that you have that view that short end rates are going to fall and long end rates are going to rise, your action would be to buy the short part of the curve, the short end of the curve, and then sell the long end of the curve. Diba? Remember, what you want to do is to buy high and sell low. So since you expect short end rates to fall, you buy the short dates or the short dated securities before the yield falls. And then you sell the long end securities before the yields rise. So that is the strategy given a view of a steepening yield curve. Now, what is a flattening yield curve? The lower left portion of this table. The flattening yield curve is, again, the pivot on the yield curve is the middle or the belly. Now, if you expect short end rates to rise and long end rates to fall, that is an expectation of a flattening yield curve. So given what we taught to you, which is the buy high, sell low rule of thumb for fixed income securities, your strategy should be to sell the short dated bonds before the yields rise and buy the long end bonds before the yields fall, right? Now, there are other terms that you might encounter as you read Bloomberg, especially these days, given that you're seeing a lot of movement in US Treasuries, right? Especially that you see now that the Federal Reserve is becoming a little bit more aggressive in terms of its rhetoric, in terms of what it's going to do to unwind its stimulus. You can see certain movements. You can see that the US Treasury market is adjusting depending on its view of how aggressive the Federal Reserve is going to start hiking rates. So that's causing some movements in the US Treasury yield curve. there are terminologies such as bullish steepener or a bearish steepener. So a bullish steepener, the pivot is actually the long end. All right? This is okay, nakikita nyo pala ako. So this is the long end of the curve, right? Okay. So this is an upward sloping yield curve. Baliktad, nakikita nyo ba akong baliktad, guys? This is a regular yield curve. Tama ba? Nakikita nyo ba to? Or baliktad?
Yes, we can see you.
Nakikita mo to? Is this
napataas ka.
pero is this
Papunta sa left.
Papunta sa left. Okay, so pag yield curve dapat ganito.
Yes, yeah.
Okay, so this is the correct yield curve.
Yes.
Okay, this is a regular yield curve, okay? So to go on with my example a while ago, a flattener is ganyan. This is a flattener. So nasa gitna yung pivot. Yan ang flattener. Ang steepener pag ganyan. Alright? Now it's different kapag bullish steepener. Pag bullish steepener, ibig sabihin yan is, what is bullish? Remember, when you hear the words bullish as well as bearish, that actually pertains to price, not yield. So bullish steepener. So dapat, nag-i-increase yung price ng bond, pero nagsisteepen yung curve. Okay? So ano yung bullish steepener? Bullish steepener is, kung ganito yung yield curve, a bullish steepener is, yan. Nag-fall ang short end of the curve, pero yung pivot na sa long end, hindi gumalaw masyado. Right? That's a bullish steepener. Sorry, I wish I had a better slide to show this. But that's what a bullish steepener is. The short end falls a lot, while the long end of the curve stays constant. Okay? So here, your strategy, since you expect a bullish steepener, you will buy a lot of the short end bonds before it aggressively falls down. Okay? Ang bearish steepener naman, ito yung regular curve. It's a regular curve. A bearish steepener is mag-rise yung long end. Ganyan. Mag-rise ang so the pivot is the short end of the curve, tapos mag-rise yung long end. So the strategy is you expect the long end of the yield curve to aggressively go up. So in this case, you want to sell the long end securities prior to the prior to rates moving up. Okay. Now it's the same thing with bullish flattener and bullish bearish steepener. Now you just have to remember that the pivot is either at the short end or the long end of the curve. I apologize for ang ingay kanina. Nasa dealing room kasi ako, guys. So nandito pa yung ibang mga makukulit na mga traders. All right. Okay. So the next example is spread trading or spread investment. So this is an example of a bond. This is a bond called Vanke Real Estate. Now this is a dollar-denominated bond that is issued by a property company that is based out of Hong Kong. So they issued a dollar-denominated bond. This was back in 2018. Here you can see that the yield of this bond is actually 5.12. That's the orange part that you see, and that the spread of this bond is actually 230 basis points above a comparable 10-year US Treasury. Ito yung sinasabi ni Toni kanina na when you buy credits is a specific space within fixed income wherein you buy these types of fixed income securities because you want to take advantage of the credit spread or the credit risk premium. Again, when you talk about credit spreads, credit risk premium, this is an additional yield that you can potentially gain by investing in a security that is issued by a corporate issuer. Kasi diba, if you buy a government security, you do not have that credit risk, especially if it's a US Treasury note. A US Treasury note, walang credit risk yan kasi hindi siya corporate issuer. It's quite inconceivable for the US government to default on their obligations. They can just print US dollars anytime to pay their obligations. So normally, whenever dollar-denominated bonds are issued by corporations, the yields on these corporate issuances are set as a spread above a comparable 10-year US Treasury. So in this case, for this particular bond, the Vanke Real Estate, the current during this time when this snapshot was taken from Bloomberg, the yield of the Vanke bond, which would mature in 2023, was at 5.12. And if you compare the 5.12 yield of this bond, of this credit, versus the comparable 10-year US Treasury, which was at 2.8, the spread is the difference. 5.12 minus 2.81 is actually a 230 basis point spread. So essentially, that you are pocketing that spread by buying this bond at a 5.12% yield. Now, why is this important to take note of? Kasi you can potentially earn a higher yield on the portfolio. Now, you have to be mindful that by going into credits, by going into issuances by corporates, there is that possibility, although remote, that the issuer will default. Okay? Kasi nga credit siya eh. But again, if you are comfortable with the credit, if you're comfortable with the credit risk, then it's okay to get into this investment and pocket that spread, the 230 basis point spread. Now, the reason why I decided that this is a good example was, take a look at the spread. It rose to 230 basis points. And look at that frequency histogram on the lower right side of this table, of this screenshot. That means this is probably the first time that we saw the spread of this bond reach 230 basis points. The average spread, if you take a look at the upper right part of this table, the average is 179. So for most of this bond's life, it's been trading at an average spread of 179 over a comparable 10-year US Treasury. And it's only now at this point in time, back in 2018, that it reached 230 basis points. So there's clearly value from a yield perspective in terms of buying this bond. So that's the reason why I wanted to show this to you. So some traders would buy bonds on the basis of value because the spread has widened. Now, these are terminologies that we use in the credit space, whether in the credits trading space, whether the spread has widened or narrowed. In this case, it's widened significantly from an average of 179 basis points. It's now trading at a spread of 230 basis points. Now that's buying. When would you decide to sell a bond in terms of spread? When the spread has narrowed significantly. So you know that this bond, on average, the spread is trading at 179 basis points. If it falls to, for example, 20 basis points, that's a good trigger for you, or a good decision point for you to decide to sell it already. So that is that is spread trading or spread investment. So there. Now let's move on from bond level strategies to now portfolio level strategies. And these are just some of the different strategies that a portfolio manager would employ when he or she manages a portfolio of fixed income securities. The basic tenet of modern portfolio theory, diba? The concept of diversification, asset allocation and diversification, right? So that's one way in which you can diversify away some idiosyncratic risks that can actually be removed by going into diversification. You can do a strategy known as yield targeting, and also duration targeting. So here, you're targeting a certain amount of return that you want to receive. That's yield targeting for your portfolio. And another is duration targeting. You're targeting a certain level of risk that you want to take and receive rewards or returns from taking that additional duration risk. That's duration targeting. So again, portfolio management decision making involves a lot of deliberate decision making. All right, so there's a lot of projections that are being made by portfolio managers. And the next is laddering and barbell, something that I already mentioned during the first topic, but I want to still discuss this briefly, very briefly, just to complete the picture, because we're talking about portfolio level strategies. So diversification, definitely, empirical studies show over the past 50 years, a lot of studies have been made showing the positive effects of diversification. In fact, I'm sure some of you might wonder, why does the PSE Composite Index have 30 stocks? Why does the S&P 500 have 500 stocks? Diba? Why does the Dow Jones Industrial Average have around 30 stocks? Because a lot of studies have been made that show that if you have a number of names, whether 30, 40, or 500 names, the fact that you have a lot of names in an index, you can consider this as a good proxy for a portfolio, a well-diversified portfolio. And I've seen a number of studies that show that actually 30 assets in a portfolio are enough to diversify a lot of idiosyncratic risks. So clearly, diversification helps you reduce portfolio risk. And conceptually, this makes perfect sense. If you're managing a portfolio for your own self, or managing a portfolio for the company that you work for, you want to be able to cover your ass, quote unquote, so to speak. Cover your ass means try to make sure that you make the most money without being too aggressive, di ba? Not gamble too much the capital or the resources of the bank. So diversification is a tried and tested way in which you could achieve that generating returns by managing the risks of your portfolio. So firstly, some portfolio managers would be cross-asset portfolio managers. So they would manage a portfolio that's a combination of cash, fixed income, and equities. And that decision to move more into cash or move more into fixed income or move more into equities relative to these other to the other two, that's an example of asset allocation. So you're deciding on what asset to buy. Now, when you are 100% cash, you are super defensive because you are not comfortable with the prospects of both the fixed income markets and the equities markets, which, by the way, I'd like to discuss now. If you take a look at some of the fixed income as well as equity funds, a lot of them in the market, both local as well as foreign, a lot of them on a year-to-date basis, negative ang year-to-date returns. And that shows that currently there's a lot of uncertainty and a lot of discomfort in the market in both the fixed income and equities market. This is basically driven a lot by what's happening in the inflation story. You have runaway and rising inflation levels, and then you also have the Federal Reserve about to do already started its lift off, and there's that risk that the speed in which it is raising rates might actually be more aggressive than initially thought of. So that's creating some uncertainties and some worries in the market. So you can see a lot of the fixed income and equity instruments not earning any money at all this year. So it's a real challenge. And I'm sure at this point, since you've been trading and you've been managing your own positions of government securities over the past few weeks in your portfolios, you've seen how quickly it is your 1 billion your 1 billion seed money can actually fall in the red or fall below your 1 billion starting point because of the bearishness even in the fixed income space, which supposedly, if you think about it, fixed income space is supposed to be relatively safer as an asset class. But again, sentiment is there's a lot of negative sentiment nowadays because of a lot of uncertainties in the market. Now, going straight into the fixed income space, if you're a fixed income portfolio manager, you can further diversify your portfolio by going into different sectors or subsectors. So the safest subsector is the sovereign sector. So you can invest in US treasuries, bonds, gilts. These are foreign currency denominated fixed income securities issued by sovereigns, governments. And then you can go into the quasi-sovereign space. So these are the likes of the multilateral lending institutions like European Investment Bank, Asian Development Bank. So these are examples of multilateral lenders that also issue bonds, and you can consider them as quasi-sovereign because the owners or the members of these multilateral lending institutions are actually governments themselves as well. So they have AAA credit ratings, and it's quite inconceivable also for these types of institutions to default because of the support they get from different guarantors, which are the member sovereigns. Next are supranationals. Supranationals are government-owned and controlled corporations. So you have the likes of, for example, PSAM in the Philippines, the Philippine Power Sector Asset and Liability Management Company. You have other supranationals like other government institutions. Land Bank could also be considered a supranational in the sense that it's also a government, and DBP, it's a government-owned corporation. And then you have banks and financials, and then lastly the corporate. So as you go counterclockwise across this pie, you're going from lowest risk to highest risk. So again, the reason why you want to diversify, if something happens in the corporates or credit space or in the banks and financial space, if you have an allocation of your portfolio in sovereigns and quasi-sovereigns, this sort of mitigates the risk because if there is a credit default in corporates and in the banking system, the sovereigns will be the safer, would relatively be safer. So that sort of reduces the risk of potential portfolio losses for you. So let me talk about yield targeting. I mentioned a while ago, one of the strategies is to target a certain yield. And portfolio managers, because many portfolio managers have targets in terms of income, portfolio income, okay, what you could do is to potentially try to reach your targets for the year by targeting a certain yield. Okay, so you have a portfolio, and then what you can do is to target the average yield of the portfolio. So one way of doing this is to target the yield to maturity of your incremental investments. So if your starting portfolio is a $1.5 billion portfolio, which has an average yield of 2.82%, that's average yield to maturity in the 6-year tenor. What you can do is to target a certain yield. So if, for example, you want to increase your yield of your portfolio, what you can do is to purposively and deliberately select higher yielding securities to reach your target yield. So in this case, I've tried, I have a portfolio that's 1.5 billion in terms of face amount, and I'd like to increase my portfolio size, deploy my excess cash in my asset allocation. I have excess cash of 1 billion and buy an additional 1 billion worth of securities. And I will buy securities yielding anywhere from as low as 4.43% to as high as 5.15%. And these can be different bonds with different tenors. Okay, so in this case, what I've done is to do that. So what happened was, because I bought an additional 1 billion worth of securities for my portfolio with an average tenor of 7 years at yields from 4.5% to 5.15%, I've been able to increase the average yield of my portfolio from 2.82% to 3.54%. So that's an uptick in my portfolio yield by as much as 72 basis points because I deployed an additional 1 billion into higher yielding securities. Again, higher yielding securities may mean credits, or may mean me going up the yield curve, going into the 10-year sector or going into the 15-year sector. So these are strategies by which you can target. So you'll target a certain yield. You'll target the higher yielding securities. Again, if you target the higher yielding securities, you will be exposing your portfolio to more risk because you're going for the credits or the corporate issued securities, and you're going for the longer tenor securities. So the combination of the longer tenor, going up the curve, or moving from cash into corporate issued securities increases the risk of your portfolio, but it's a way of achieving your yield target. Okay. The next is duration targeting. Now, this is a good example because we've just talked about Toni did a really swell job in terms of explaining to us the mathematical as well as the conceptual basis of the duration measure being an approximation of your interest rate risk or the price risk given interest rate movements. So you can have two scenarios here. If you manage a portfolio and you see that something is happening, if you have managed a portfolio and then you see that interest rates are moving higher, if interest rates are moving higher, the potential impact on your portfolio is declining portfolio values, especially if your portfolio has a high duration. So one thing you can do is to reduce the duration of your portfolio. And some of the things that you can do is to sell securities out of your portfolio. But the problem with selling securities out of your portfolio, you lose the potential yield kasi by selling it, it becomes cash and it becomes idle in your portfolio. So what you can do is, if you want to still remain invested, even though you want to reduce duration, but still remain invested, your cash is still working for you, what you can do is you can actually buy securities to reduce the portfolio duration. And how can you do that? So in scenario 1, we're looking at an existing portfolio of $1 billion at 4.25% with a modified duration of 7. 7 again is remember, modified duration is no longer expressed in years. Modified duration is expressed in percentages. So if you have a 7 modified duration, that means your portfolio is sensitive by 700%. Okay, that's how much potentially the portfolio value can decline kapag umakyat ang interest rates, 700%. All right? So yung modified duration mo is 7, and now what you want to do is to reduce the duration of your portfolio. So I've decided to deploy an additional $1 billion into new bonds, but this time I am targeting low duration bonds. So from a 7 modified duration of my portfolio, I've purchased $1 billion worth of bonds with durations close to 1. And because of my introduction, my doubling up of the size of my portfolio at a low duration, I've been able to effectively increase the volume of my portfolio twofold, from 1 billion to 2 billion, but the modified duration has dropped from 7 to 4. So again, now because I've bought a lot of short duration bonds, the average duration of my portfolio has now fallen to 4. it's become less sensitive to market movements. Now, on the flip side, if you are if your view is that interest rates will start moving down, you can take advantage of your view of a decline in interest rates by increasing your portfolio risk. And you can achieve this by purchasing securities with high duration. So let's start off with the same scenario. You start off with a 1 billion portfolio at 4.25%, and the duration is at 7. By purchasing an additional 1 billion of securities, or you're doubling up the size of your portfolio and targeting securities with a modified duration of 8.5 to 9.5 years, 8.5 to 9.5, I won't use years, 8.5 to 9.5, I've effectively increased the portfolio duration from 7 to 8. So it's now more sensitive, and I can take advantage of my view that interest rates will go lower, and now my duration is higher. Hence, the portfolio can potentially move higher in terms of value. The speed by which the value of the portfolio can increase given the decline in interest rates view is actually even more. Okay, and then my last 2 slides is just showing you the concept of laddering, which is basically just maturities management. When you're managing a portfolio and it's important for you to have cash flow every year, what you want to do is to ensure that every single year you have bonds that mature. So you have bonds that mature in 2019, 2020, 21, 22, because by having that, by spacing out your maturities across different time buckets, you're ensuring a ready source of liquidity to redeploy the securities whenever these securities mature. So that's the beauty about laddering. And this is actually better when your view is that interest rates are moving up. So each and every time your securities are maturing, you are able to deploy these at incrementally higher interest rates when these bonds mature in the near future. All right. And then lastly is a barbell. I will not go through this anymore kasi napag-usapan natin. But essentially a barbell is taking a position in extreme ends of the yield curve. A lot in the short end of the curve and a lot in the long end of the curve. So that formally ends my discussion on portfolio management strategies. Thank you very much for listening. And I turn the floor now to you, Cams.
Okay. Thank you, Clive and Toni. So now, since we skipped over to Toni's presentation for the questions, if you have any pending questions for from Toni's presentation or even to Clive's presentation, we can move on to that. So I feel and I hope maraming magtanong from Toni's presentation because it's very technical, but Toni did a great job. Kahit ako nakinig ako. I've been very rusty, not having traded for so many years. So to our participants or to our non-participants who are attending this talk at this presentation, okay, we have from Outsmart. Okay, go ahead.
Okay, hi, hello.
Gabriel. Hi.
Hi, Miss Toni. You mentioned, I just have a question. You mentioned something earlier. This was about the types of offerings. So you mentioned that something like best effort, and I forget what the other one was.
Underwriting.
Underwriting. So which of the two would you say is, I guess, more common, and like are there any? Are they both very common? Okay. And
actually, the more common one is Gabriel would normally be best efforts. I think the main reason behind, so previously what was more common was the underwritten primary issues. But given capital constraints globally, and then of course you have more and more foreign counterparties, I think they're closing some of their investment houses shops. So I think we are moving more towards best efforts basis now, mainly because of all of these metrics that we would need to comply with following regulations. So previously it was underwriting, which is the more common type for primary issuances, but now it's more best efforts. So in best efforts, we would normally rely on the sales force and the selling capability of the selling agents, which is tied to the underwriter which is tied to the syndicate rather, when the issuer is choosing which investment banks to choose for this issuance.
Okay, I get it now. Okay, thank you.
Okay, we have a question here. I think this is for Clive. Is there an ex-post desk team performance measurement or desk group to analyze effectiveness in using asset allocation yield and duration targeting strategies to say that these FI portfolios are actually generating alpha against their BM?
Very good question. I will answer from the perspective of an asset manager, like a trust corporation or an asset management company managing mutual funds. Yes, there are separate desks within these types of institutions, financial institutions, that do performance benchmarking. There's a separate team that does the performance benchmarking. It does the performance attribution analysis. There's a lot of quantitative tools being used to do these attribution analyses. But at the end of the day, it's really to check whether the portfolio managers are doing their jobs. Because in the realm of trust as well as portfolio management, these portfolio managers are compared and pitted against one another. And for you, how do we know exactly that these portfolio managers are doing a good job of generating alpha or excess returns? It really is how good they are against a benchmark that is widely accepted by the markets. So these benchmarks should be reflective of the strategy that is being employed by this portfolio manager. Now, again, I want to say that this is being used by trust companies, by asset managers, but not much for treasury departments. Simply because in treasury, we don't manage portfolios this way. Yung mga trust companies kasi, trust companies, asset managers, they manage stylized portfolios. They manage portfolios that track certain benchmarks. So essentially, that's to make the comparison fair, dapat the benchmark should reflect the strategy being employed by this portfolio manager. Sa mga treasury departments kasi, there isn't a portfolio management team that does it this way. This portfolio management is done and trading is being done on a per market basis. So you have a separate portfolio management desk that focuses on corporates and another portfolio management desk that focuses on government securities. And again, we do not have benchmarks that we pit ourselves against or compare ourselves against, kasi that is not we're not trying to beat a certain benchmark or try to show that we're better than other portfolio managers from other treasury departments. Our KRAs and our targets are different. Our KRAs and our targets are more on the interest income as well as realized trading gains side. So that's the difference. So I want you to take note of the portfolio management from a treasury standpoint is different compared to portfolio management from trust as well as an asset management company.
I think there's a follow-up question. Is laddering the best strategy to eliminate performance or cash drag under the portfolio because you already have a forecast of maturity? Very technical questions.
Yeah, very technical question, but I love it. I love it that you guys are asking these kinds of questions. That shows na lumilevel up na ngayon ng mga universities in terms of what you already know. Naisip tuloy ako, Chris, baka they find our lectures too
not too
basic. But kidding aside, guys, laddering is a good strategy simply because it just ensures that you have ready liquidity regardless of what happens in interest rates. But it's always best to implement or employ a certain strategy if you have a view, and that you should be able to put your money where your mouth is, diba? So kung saan yung view mo, dapat you take an action on that view, and that's why laddering could possibly be a good strategy. And as I mentioned a while ago, it would be you maximize potential returns or potential increase in portfolio value if you do a laddering strategy whenever you expect interest rates to move up. Yeah, and important sa inyo yung liquidity. And I'd like to siguro on a more personal note, if you manage your own portfolio, you have cash, you manage your own portfolio, you might want to have a laddering strategy kasi you'll never know when you need the cash, diba? So on a more personal level, maganda if you have that liquidity and you're not all tied up in very long-term fixed income securities. Maganda na you always have that flexibility to deploy or invest your excess cash or investable funds every single year, di ba? There's always an opportunity if you have cash.
Okay. I have a personal question for na sinend sa akin to Miss Toni. As someone who handles sales now, do you also need to compute for PV01?
Actually, yes. Admittedly, I would normally use PV01 mainly for for swaps, for derivatives trades, because may duration din kasi yung derivatives eh. But as it is, for fixed income, normally it's not part of how we deal for sales, because normally for sales, it would normally just be bid offer, no? But as it is when we have conversations with clients, no, in order for us to have intelligent conversations with clients, we would normally need to have this information also very handy, and also like prognosis on where yields are on the market also.
Okay. Okay, eto, may question tayo in the chat box. I think both your inputs would be very welcome. Derek Matabredo from San Mateo Municipal College. Ask ko lang po, bakit mas maganda po bumili ng securities during mataas po ang yield curves besides having low price? Okay. Toni, I guess, ikaw muna.
Oh, sige. Ako, I would normally think of it in a way na parang for my own personal finance, no, I would think of it na parang if I don't invest my money, it's earning zero. And I don't have that value of what we call compounding. So as it is, no, given that levels are already higher now versus when we were starting the pandemic, no, as it is, I would normally look at it na parang if I need X amount of emergency cash, I would put it in short-dated securities. If, for example, I can spare X amount of cash and I can invest this in longer tenor securities, I will do that. Basically, what I am doing is I am diversifying my portfolio when it comes to different parts of the yield curve as it is. So for me, it's just me comparing it versus me earning zero, no, and me putting it under my bed and under my pillow. So it's not really me paying less in terms of cash now. It's me earning the yield, no, whenever I'm holding on to a fixed income security.
Okay, can I add to that?
Sure.
Go ahead, ma'am.
Yes.
Go ahead, Ms. Chris.
Okay, the question is why it is more, what is
Bumili.
better
Mas
to
maganda
invest
bumili,
while
yes, ng securities.
the yield is high.
I'm sorry, ang question niya pala is
Because
bakit maganda bumili
lending
ng
money.
Sige, go ahead.
So if you are lending money, you should be earning interest for that, or you should be paid for that. Somebody should pay somebody should pay you for the use of your money. As a lender, you want to earn higher, so you want higher rate. While as for the borrower, you'll be the one paying the cost of using the money, and that's when you sell. You would like to borrow at a lower rate. So that's how you should look at it. So when you buy, you are lending, so you want a higher payment for the use of your money, and when you sell, it is equivalent to you should be you would like to have a lower rate.
Okay,
Yeah?
Clive, if you have anything to add.
Okay, sa akin naman, yung yield curve na mataas.
I'd like to ask, answer this question na personal. Ang tagal ko kasi mag-type eh. So,
Medyo nakakat ka lang, Miss Chris. Medyo choppy lang yun.
Choppy ka.
We have the T-bills rate maturing on July 13, October 12, and April 12. Since nobody
Okay.
We are encountering technical difficulties.
Technical difficulties with Miss Chris Arceo. So, sige. Miss Chris, are you there? Sige, Clive, go ahead. Ikaw na muna.
Okay, ako na muna. yung mataas na yield curve levels now, we haven't seen this in a long time. So this is actually an advantage or a benefit for those who have no investments yet. Diba? And I'd like to link this to what Toni was saying kanina na if you want to maximize the yield, kung wala ka pang investments na on fixed income, now might be a good time kasi mataas na siya eh. Mababa yung ano mo eh, yung basis mo eh, wala kang investment eh. Pero a higher yield curve is actually quite bad for those who are... Ay, ayun na si Chris.
Sige, Miss Chris.
Can you hear me?
We can
choppy,
hear you.
yes,
Choppy
we can
lang.
hear you, but choppy lang. So we'll let Clive
Yeah,
finish.
pero choppy.
Then we'll
Is
get
it
back to you.
better?
Pero
Better.
choppy
Is it
pa
better?
rin.
Yep, better.
Yeah. Then yun na sa bills, nobody participated last week. And so, oh my God. Anyway, Clive, can you explain na lang the T-bills, why it was changed?
Okay. All right. Just to remind all the participants in the competition, every week, there is an auction of T-bills during Monday. So, ang nangyayari dyan is, since nobody participated in the first T-bill auction, we removed it from the list of the bond definitions tab and then replaced it with the new set of T-bills that were issued early this week. So, ganun na mangyayari. Each and every time na merong bagong T-bills na i-auction, ibabaguhin namin yung bond definitions tab, lalo na kung walang nag-participate. But I believe may nag-participate itong earlier this week, ano? Di ba?
None from
wala
the
din.
participants
Yes,
I handed.
there-
May nag-trade.
yes,
Meron?
In the secondary market, yes. May nag-trade, but
somebody, one
may
team
nag-auction.
was awarded
Okay.
in the T-bills.
Okay.
Okay, Clive, to finish off what you were discussing regarding the question.
Yeah, okay. So for those who currently hold on to bonds and then umakyat bigla yung yield curve, that's potentially na delikado kasi mamamark na negatively yung hawak nyo na bonds. So yeah, so it's really relative. What is your current holdings, or do you have any holdings? And if you do not have any holdings, now may be a good time to start buying bonds kasi mas mataas na ngayon yung yield curve. And the further you go up the yield curve, potentially the higher the yield that you could get. However, going to the lecture kanina pinag-usapan natin kay Toni, higher yielding bonds because you're going up the yield curve means higher duration risk. And higher duration risk means you're exposing potentially your bond holdings or your portfolio to more sensitivity kapag gumalaw ang interest rates even higher pa than which you got when you originally invested.
Okay, thank you. Before we move on to the next question, we would like to remind all the participants to stay put. We have some announcements to make after the question and answer portion. So there's another question here in the chat box to actual corporate setup. Is MODIF duration, Macaulay duration, or other FI indicators, are these simply calculated by Excel functions? Or is there a larger employed software to calculate for a larger scope of FI portfolios, which potentially change the calculation methodology or simplify the theoretical factors involved to arrive at final value of these indicators?
So from earlier, I showed you that you have Bloomberg functions for this. From what I gathered, and if my recollection is correct, Bloomberg has a specific module parang for that you can parang upload the portfolio, and then that portfolio would calculate those indicators. But ideally, I think easiest would be you have Excel, but as it is, there are actually softwares available for you. But the easiest accessible would just be Bloomberg and Excel for now. But for us, like for example, for SCB, we have our own proprietary system, so which would have these metrics also.
Okay, but Excel can actually compute for the basic. Yeah. Is that correct?
Yeah,
okay,
that's correct.
Okay, any other questions you can just raise your hand or type it in the chat box. Yung mga nahihiya, pwede mag-personal sa akin. Actually, to the participants, take advantage because Toni and Clive are very good lecturers and seasoned lecturers na sila. This is not their first time presenting, being asked questions, so take advantage.
Toni is one of the teachers in Treasury. TCP, nagtuturo ka, Toni, no? Sa
Yeah,
TCP.
pero hindi na. Na-busy na. Regular kasi yun 5 times a year.
So that's the certification program that Clive mentioned before that traders have to take in order to be able to trade. Okay, external participant here. I only learned this on CFA Philippines. How do I know of other future lecture, or is this limited to colleges? Medyo hindi ko naintindihan yung question mo, sir.
Okay.
Sige,
she's
ma'am.
not part of
Chris?
the participant. So she she learned about from the CFA
from the Philippine
page.
Okay.
Yeah, we're opening this to other participants.
And non-participants of the markup.
Yeah, that's
he or she.
Really
Go ahead.
Okay, go ahead, Ms. Chris.
Because objectives are financial literacy.
I think the comment is stemming from the fact that they find this this lecture quite interesting. Kaya they want to know if there are more similar lectures that we would be providing. And how will they find out about this? How do I know of other future lectures? I guess through CFA Philippines, if there are more tie-ups between CFA and the industry associations as well as the banks, this can be offered, and you will be made known. It will be made known definitely through the app and through the website. Yep.
But for now, these series are inaugural. This is the first time that these are as consistently being held because of the markup. So our hopes are to do this on a yearly basis. So as we go along, we improve on how we're going to be disseminating the information and the lectures to more people other than the participants joining the markup. Okay, so for the markup, our trading blotter still has the first week's T-bills. Could we request for the updated trading blotter? Okay, we will deal with this later. With your question, Queenstein. Okay, this is very in-depth comment. This is a very in-depth on a practical application and for those working professionals. Yes, that is correct. And yan, we have 2 examples of the working professionals na came up with these presentations. So hopefully we can address this more. Okay, merong personal question dito. For Toni, for Miss Toni, having gone through trading and sales, what is more stressful? Okay, Toni, answer.
Different levels, different kinds of stress. I would say that stress is relative and it's all in the mind. As it is, parang, I've been, as I mentioned, in trading kasi different ng metrics. So ideally, you're just looking at performance, you're looking at budget. But it's very difficult to call the market. So as it is, you would need to read a lot. You would need to be brave in opening positions, and then you would need to be disciplined as well in having stop loss levels, just in case the market moves against your view. But in sales, naman, the difficulty is you would normally need to multitask. You need to be aware of the various products also, and then you need to be at the face of your clients at all times. So as it is, so different levels of challenges, in both career paths.
Okay, may follow-up question siya. How can having a CFA degree, actually CFA is not a degree, but is having a CFA helpful in sales in general?
Okay, so I think for me, the technical knowledge, because as it is, you would learn a lot of products also through the materials of the CFA. So as it is, that's your first step because once you have that foundational knowledge, it's easy for you to in a way use that in practical and use that in a practical sense. No? And then secondly, I think it's more of the code of ethics as well. It's very important, and I think clients really appreciate that you're in a way with the way you deal with them. No, it's in an ethical manner. So those two things, it's really more theory, product, and also that code of ethics. And technically, 3 levels kasi yun na you would be learning about the code of ethics. So in a way, medyo may imbibe mo talaga siya in a way.
Good answer.
Sabihin ko nga ng good answer. Okay, to Clive, in local portfolio management, what is the typical starting point to reach portfolio manager or even be involved in desk trading?
That's a good question. And I know that a lot of college students who get a little glimpse of what it is in the treasury departments of banks would want to eventually end up here as a career, diba?
Yes, that's why. Hence the questions.
Yeah.
Kung kailangan ng CFA.
Definitely, certifications such as the CFA can help you get ahead. I mean, definitely employers will take a look at whether you have the academic rigor to be able to finish all 3 levels of the CFA exam. And by doing so, you can show that you can do it. And actually, there are certain desks in Treasury wherein it is very, very highly quantitative and highly that academic rigor can be used in certain desks in Treasury. So yes, definitely it will help. Now, for those of you who will not go through a certification program, you can still end up in Treasury. However, you will have to go through, like in my case, what I did was I had to go through the long way. Meaning I started off as a government securities trader for a local investment house. And I did that as a strategy for my career to be able to get into the market. Because once you join a small financial institution na meron treasury, that those members in that treasury department from that small company are members of MART, the Money Market Association of the Philippines. And that's where you can get to learn from other members, other MART members, from other traders, and from other banks kung merong mga opening sa treasury department sa mga bank na yan. So that's the route that I had to go through. So I started off with a small company, and then I moved to Equitable PCI Bank Treasury. I did also sales. And then eventually I moved to an asset management company, hence my experience in portfolio management. That's where I met Chris. Chris was my boss in Philam Asset Management. So she hired me. And then after Philam Asset Management, I moved to BPI. So I've been in Treasury my entire career. But yes, it really has to be, that has to come from you, that desire and that want to be in trading and to do trading. You have to be able to show that to potential employers. Kasi the skill set that's required in trading, kakaiba. Dapat marunong ka, you know how to read markets, read news, you know how to implement strategy, you know how to develop strategy. And it's a different kind of skill set. So maraming soft skills ang kinakailangan para to end up in portfolio management or in trading. Pero I think most importantly, kailangan ipakita mo sa mga employers na ito ang gusto mo.
Yes. Yeah. Oh, let's hear from Toni. You can also answer the question. From another point of view.
Manager. Yeah. But well, I kind of agree with Clive. Well, you need to start off with knowing what you want. So as it is, I started my career in the global financial crisis. So at that time, no one was really hiring the treasury. No? So for me, the next best path for me would probably be asset management. So that was where I started. So essentially, I was already in the markets because I know that I want to be in financial markets. So from asset management, when the financial markets slowly recovered from the GFC, that was when I started to pass around my CVs, and that's when I made my move to Treasury. And then I never left Treasury from then. So I just moved from one bank to the next with a different role, but I settled in sales, as mentioned by Cans earlier in the intro. So it all starts with you knowing what you want, and then you can start out where you think the opportunity will lead you to that if that opportunity is not present at the moment.
Okay. So another question here to Ms. Toni and Clive, how are the limitations or stops tradings computed? Is it a set of equations? Is it a set of amounts? And how are the, sorry, parang hindi ko main. How are the equations that Ms. Toni presented earlier used?
Okay, so I'll probably answer. Earlier, the equations that I presented, it's really for duration. No? So as it is, as I've mentioned, there are a lot of models that you can use. You can simply use Bloomberg, type a bond, no, and then type yield YAS. So you can see, and you will just see the duration there. What I presented to you is just the long cut way for you to compute for the duration, Macaulay duration, modified duration, for your appreciation. Because for me, when I'm studying, I normally don't do shortcut methods kasi, so I would normally, medyo anal ako that way. I would still look at how that formula was arrived at and how that number was arrived at. So that's why I presented it to you guys. But it will depend on you. You have other tools available, Bloomberg, Excel, such that you won't need to go through that calculation manually. And then, sorry, what's the next question? Ay, Cams, nakamute ka.
Nakamute ka.
Napindot ko. Sorry, napindot ko. How are the limitations or stop tradings computed? Is it a set of equations or is there a set amount?
Well, I'm not really a trader currently, so medyo makapasay na yung knowledge ko. But back in the day when I was still trading, normally, like for our positions, it would be mark to market on a daily basis. And then there would be loss alert and stop loss limits instituted and approved by, normally it's a risk committee. So if the mark to market loss, it goes beyond a stop loss limit, normally stop trading na, for example, until you unwind that losing trade. So that was my previous experience. So, but in instituting, like for example, your own stop loss levels, it would really be dependent on you. So up to what amount of loss are you willing to hold on to your position? So for me, that would be my main question. So back in the day when I was trading, iniisip ko, like for example, ay medyo malalakihan na ako sa 1 million pesos na loss. What would be that 1 million pesos loss? So how much would that be in yield? And that would be my stop loss level in terms of yield. So if that yield is met, then that would be my signal for me to unwind my position right away. So that would be, yeah. So I'll pass it on to Clive. Baka mas may
okay, yes.
Actually, hindi pa yan pasay. That's still being used, Toni. So ganon, at least some other banks, what they would do, to answer your question, usually yung mga stop loss limits na yan, that's being set by the risk management committee. Tama ka dyan. And usually these stop loss limits are a certain percentage of bank capital. So remember, when you're in the banking business, capital is key to ensuring the long-term solvency of the bank. So the higher your capital levels, the better. Now, in treasury, when you're in trading or in portfolio management, there's a risk that this capital can get mag-deteriorate ang capital because of your risk-taking activities. That's why to be able to protect bank capital, the risk management committee will approve a certain percentage only of this bank capital that they are letting the traders, allowing the traders to take on in terms of risk. And yun pwede siyang makain, but only up to that level. Once that gets hit, stop trading na lahat. Tama si Toni. And usually ang ganyan, pag ganyan, you will be asked to explain what caused the hit, bakit natamaan yun, and then what is your recommended course of action. Normally it's to unwind the positions to stop further bleeding. But yeah, it should be a percentage of capital. And ang kagandahan dun sa duration, the PVO1 measure na tinuro ni Toni kanina, it gives you sort of an idea what will have to happen to rates for you to hit that stop loss limit. Kasi you know na what is the potential decline in portfolio value because you have a PVO1, a PV, present value of a basis point. Obviously, if you have more positions and higher duration securities, mas mabilis bago matamaan mo yung stop loss limit mo. So yun, that's how in reality, in a practical basis, nagagamit itong mga measures na to, duration as well as PVO1, how it can be used to help the traders have a feel of what has to happen in the market before your stop loss limit gets hit. But yeah, these are very practical and very useful tools.
Yes, so hindi siya set amount to all institutions. It's different, depends on the capital. Depends on the capital.
As well.
Okay, go ahead,
Yeah,
Ms. Chris.
sometimes the stop loss, the traders limit are determined by the trading gain for the year. So for example, you have a set profit target for the year, and then it is the VAR or the value at risk will be equivalent to about three months of your annual target. And then the stop loss limit or we call it the management trigger. It will be about 2 months of your annual target. So that's how we apply that's how we compute for our limits.
Okay, next question. Consumer question. What are the local banks' basis for loan interest rate? To be specific, which Philippine government bond tenor or the common basis? Okay, so Toni, maybe you can answer first.
Normally, for loans, we would use the corresponding benchmark tenor. So if, for example, a corporate client would have a 5-year fixed rate loan na drawdown, the basis would normally be the 5-year BVAL rate plus the credit spread, depending on the borrower. So that would normally be the case for loans. That would be for wholesale loans, though. For consumer, for SCB, we don't have a retail bank anymore, But as it is normally for wholesale loans, meaning our corporate clients would be corporates, that would be how we would price it.
Okay, Clive, if you have anything to add.
Yeah, nothing to add, but just the rule of thumb there is that when you're pricing a loan, it should be based off a comparable tenor na government the benchmark. So kung 5-year bond, a 5-year na loan, dapat based on the 5-year BVAL. Or 3-year loan, 3-year BVAL. Yeah.
Okay, Ms. Chris mentioned target levels. How are they computed or set? Good question. Paano ba?
Well, each bank they have budgeting exercise. So, for example, a bank, if we make 15 billion today, and the bank says, okay, let's make it a 10% increase or whatever. So let's have say an 18 billion profit next year. Now it will be divided among the units of the bank. And the units of the bank will still divide it among the different groups or traders. So if we have for example, just an example, for our group has a 2 billion target, then we divide amongst ourselves. Depending on the...
Laki naman.
Laki naman yan.
Laki naman yan. Buti wala na ako dyan.
Diba?
For everyone's information, Ms. Chris is also used to be my boss in China Bank. So, may mga
just a trivia na lang. A trivia. The members of this committee are were at one time or the other has been under me. So,
yes. Mga alila. Alipin.
So, kaya madaling nabuo ang team.
Yes. And also trivia, Toni used to be our client in China Bank. That's why we know each other. So, for everyone's information, if you get to work in the finance industry, especially in the money market, more or less magkakakilala. Parang showbiz yan, participants. Magkakakilala kayo lahat. Even the chismis, alam nyo lahat.
It's a small world.
It's a really small world.
When you were
small.
saying, oh, what if what if you do this thing or nagreneg ka?
Yun.
You're marked for life. You are marked because everybody knows everybody.
As we discussed last time in the ethics lecture.
Yes, so you better behave.
Anyway, okay, next question. In finding value, what is the priority factor to look for? I guess this is for Clive.
Okay. It really depends. Kasi the relative value na strategies that I mentioned a while ago, as I mentioned, parang you can look at relative value across the yield curve. You can look at relative value across the same industry, or look at relative value across similar credit rating. But at the end of the day, relative value still looks at which is the highest yielding. Right? Kung ano yung may pinakamataas na yield, kasi that means that's the cheapest. So when you're looking at relative value, you're trying to determine which are cheap and which are expensive. And if you see an asset that's cheap, you buy it. If you see an asset that's expensive, you sell it. And this is always cheap or expensive relative to something else. So relative can be from the perspective of similar risk securities, and similar risk can be captured by credit rating, or captured by similar industry, or captured by same issuer. All right. So that's what relative value. And relative value can also be cheap or expensive relative to the past. So it's it can be time bound, or it can be cross section. So that's what relative. Basta it's all about identifying which particular securities you can potentially get a higher yield for the same or similar type of risk. So there's no hard and fast rule here. Basta kung ano yung applicable dun sa gusto mong gawin, or kung anong market that you are handling. Kasi if you're a credits trader or credits investor, you'd want to look at same industry or same credit rating. But if you're a government securities trader, your relative value is looking at the yield curve. Saan yung value sa yield curve? Or looking at is it cheaper or more expensive relative to the past? Has it cheapened, or has it become more expensive or become richer? So these are terminologies that you will encounter in portfolio management or in trading when you're looking at relative value.
Okay, thank you. For Ms. Toni, in dealing with corporate clients, what is the difference in their requirements and targets in relation to the banks?
Okay. For corporate clients kasi, most of their requirements would be foreign exchange, hedging, and then sometimes if they have a custodian, saka palang merong fixed income and securities na requirements. So and then you would normally see them also in the time deposit space. But for banks, majority of their requirement would be assets and funding. So we would normally service their funding requirements via repos. I mentioned quickly what repos are earlier, which are collateralized borrowing activities. And then separately, the asset space naman, we would show them securities. So you would have structured notes, you would have plain vanilla bonds, you would have certificate of deposits, for example. And then finally, for banks, they would also have that concept of hedging. So we would also be dealing with them derivatives too. So for corporates, they're not under the purview of the BSP, but banks are under the purview of the BSP. So for derivatives trades, we would need to ensure that they have the ample derivatives licenses for banks. But for corporates, there's no such thing. We just need to ensure that the products that they're dealing, they are within their board-approved secretary certificate. So magkaiba in a way, mas heavily FX and derivatives yung corporates, and then mas heavily securities related kapag banks.
Okay, may follow-up question siya. May difference po ba sa requirements ng private versus GOCCs, if you're dealing with GOCCs?
GOCCs na banks or GOCCs na...
Okay, to the questioner, GOCCs na government in general. Oh,
government in general, wala. For us, it's going to be the same. So like a SecCert, for example. But as it is from my conversations with GOCCs, they may have a different approval process versus other private corporations. Because usually parang they would have their own mandates, tapos sometimes their approval process, sometimes baka kailangan pa ng approval from another government agency, for example. So as it is for us, for banks, we would normally need the same requirements.
Okay.
From them.
May follow-up pa siya. Aggressive din po ba sila? Gusto ko yung mga ganitong line of questioning eh. Aggressive din po ba sila?
Normally, hindi masyado. Parang more on the plain vanilla lang yung ini-investa nila for the GOCCs. So we would see them in the fixed income markets also. But from my conversations, they're looking at delving and exploring derivatives and structured products. So probably in the future, we would see them doing this already.
Okay. Okay, personal question to Ms. Toni. Bakit ba ako? Suki ako ng mga personal questions eh. What do you teach in TCP?
I no longer
TCP.
teach TCP.
That's what you mean.
So I no longer teach TCP. So previously I handled risk management, securities dealership, and interest rate derivatives.
Okay. Nag-stick ata dito sa questioner. I'm not gonna mention yung because you're an advocate for learning, continued learning. So I think yun yung interested sila to know what you actually teach.
I would normally have sessions also with MART and the CFA Society Philippines and the Ateneo CCE, Center for Continuing Education. So I would have regular webinars there also. So you can just visit their websites.
Yeah.